Good afternoon and welcome to People Making Money. I'm your host, Kevin Bemmel, and we are here every Wednesday at 12:30 p.m. Pacific, 3:30 p.m. Eastern, with an hour in for Central and Mountain. And we talk about all things related to professional success and wealth building. So sometimes I have a guest who has achieved professional success, largely as they define it. So I had a guest recently who he did not define success in monetary terms. He's comfortable financially, but he really measures his success by the number of people that he's able to impact positively. Other people, they define their success in terms of financial success. So, one of the challenges of contemporary life is, what does success mean to each of us? There was an article in the I think the Wall Street Journal. I think it was this morning, although maybe I saw it in something online, that said, no, I take that back. It wasn't in the Journal. It was in a newsletter I get from a friend of mine every day. And it was saying that young people, I think millennials, they're absolutely willing to make trade-offs in their professional lives, whereby they're able to do something that they feel is important and worthwhile, even if it means making less money, or they're willing to, they value flexibility in their working situation over more money. So that's a shift in a definition of success, certainly from my generation, where success was largely defined in financial terms. Although I would hasten to add that I think the baby boomer generation was kind of at the forefront of thinking about success in kind of broader terms, if you will. But in any event, I digress a little bit, but I think it's important to talk about these larger issues from time to time. Today, we're going to talk about credit scores. So I think there's a lot of potential misunderstanding about credit scores. There's certainly a lot of mystery around credit scores, and we'll talk about that today. But the reality is that for certainly most consumer lending decisions, a credit score, the lender is going to look at your credit score. Now, if you're young and you haven't established credit yet, so you may need to look at some alternative way of establishing credit. Okay. I know when I was very young when I started my first savings account. I think I was 13 with my bar mitzvah money. And then I think when I was 16, I had my first checking account. Now those don't go on your credit profile, but you can see that at a fairly young age, my parents were preparing me to gain financial literacy, if you will. I got my first credit card when I started college as a freshman in 1978. So at the time, Bank of America, which had a branch right across the street from where I went to college, which is USC, they had something called I believe it was a college credit card or something like that. But basically, they approved me, and pretty much I think anyone who applied for a credit card, I think it was a Visa card or maybe a Bank of America card back then, with a $100 limit. Now, today that would probably be the equivalent of maybe, I don't know, $300-400, because that was 1978. So that was almost 50 years ago, 45 years ago. What has inflation been in that time? But I mean, I will tell you, $100 seemed like the world. I was very popular with my friends because I could charge a pizza, you know. And that's where I started building my credit was when I was 18 years old, and it built from there. Now that was way before credit scores; they weren't around then. But nonetheless, it is a good idea if you have not established credit yet, but you do think that you want to buy a house, and or you want to buy a car, and you're not going to pay cash for the car. It is a good idea to establish credit as soon as you're able. And that's one of the things I'm looking at with my daughter is how we can do that. So, having said that all, you may need to look at an alternative way of establishing credit. Okay, either because for whatever reason you don't qualify for a credit card right now, or maybe you had some credit difficulties in the past, and now you need to reestablish credit. I know, again, this is going back a lot of years now. I was probably in my 30s, so we're going back, a good 30 years ago. I was dating a young woman who did not have good credit, and she needed to get a car. And so we found a car dealer that was willing to use things like utility bills, phone bills, that sort of thing, in order to base a credit decision. And I imagine, that can still be done today. And while typically, the electric company and the water company and the gas company and such, typically they don't report credit information. You can certainly use them to, I would encourage you, if you're, young and starting out, then, start these accounts and get at least in the habit of, paying monthly bills, because that is, in the end, that's what establishing credit in. It's having someone extend money to you for a period of time, even if it's only for a month, and seeing to it that you can pay it off. Now these days, it's so much easier than it was when I started out, in the sense that you can, for almost any creditor, whether it's a utility company, whether it's a credit card company, a mortgage lender, a school loan servicer, you can go online and you can set up to have the monthly payment made automatically, either directly from your checking account, or you can have things charged to your credit card, like with your cell phone. So that's another way of starting credit. So if you're a young person getting started, maybe right now your parents are paying for your cell phone directly. So one of the things you might want to do is start paying, put the cell phone account in your name, even if your parents want to still pay for it, and lucky you, right? Have them give you the money so that then you pay the bill each month, and that will allow you to establish credit. Okay, and in something like that, you may be able to do that even while you're still in high school. So these are all things to consider in terms of establishing credit, so that you will build enough of a credit history in order that you will have a credit score. So when the time comes for, shall we call it a serious credit decision, a credit card, an auto loan, a home loan, you will have your credit score established, and that won't be a hindrance to achieving that goal. So we're going to talk about a number of different aspects of credit scores. And I because it's kind of a complicated topic, I did prepare a PowerPoint so that you can see these different aspects. And if you do want a copy of the PowerPoint slides, happy to share it with you. After the show is done, it'll post to our YouTube channel, and you'll see all the different ways to contact me. Feel free to send me an email. I'll be happy to send you a copy, of the slides, so you can have that. Well, that was weird. Okay, so anyway, here we are, people making money. And there, okay, there we go. And everything we do on the Way to Wow shows revolves around this concept of the 3 pillars of attainment. We're dealing here in the pursuits pillar, in the finances realm, and that's generally where we hang out. Okay, but oftentimes when we're talking about professional success and or building wealth, that's going to connect into relationships. And when we talk about, when I was talking about, well, each of us has to define what success means to us. So that's really part of our identity. How do we see success in a way that supports the person we want to be? Okay, so the definition of a credit score, if you will, it's a numerical representation of credit worthiness. Okay, so the most well-known, and which you'll see in an upcoming slide, is something called a FICO score, and it's a three-digit number that says that says, this is basically how good a credit risk you are. So they range from at least FICO scores range from 300 to 850, and the higher the number, the better the credit risk you are, the more credit worthy you are. So that's the idea behind credit scores. FICO is a shrinking of Fair Isaac Company, and it was the Fair Isaac Company that originally came up with this concept and the way of doing it. They eventually, and they called it a FICO score, and they eventually changed the name of their company to FICO because it was such a well-known thing. And FICO score is kind of like Xerox copy. In the sense that a Xerox copy came to mean any kind of photocopy. So people talk about FICO scores. There are other companies that generate credit scores. They have different ranges. I'm going to be talking about FICO scores because it is the most common, but just recognize that there are other ones out there. Okay, so what a FICO score does is it gathers information about you and it turns it into this 3-digit number. Okay, and you see here the 5 aspects of your borrowing life, I guess we'll call it, that go into a credit score. Now, how much each one of these is weighed and all of that kind of stuff, FICO doesn't say. Okay, that's a proprietary software program that they have that spits out that credit score. And so they, I can't tell you, is each one of these weighed 20%? In other words, given equal weight? I have no idea. And FICO is not saying. So, but let's go through each one of these so you understand what they are. Okay, and then you can get an idea of how it might play into your FICO score. So first and foremost is payment history. In other words, have you made your payments on time? Number one. And number two, for how long have you been making payments? Okay. And three, do you pay your balance in full or do you carry a balance? Okay. And depending on the type of credit it is, that, carrying a balance can be, good or bad. Okay. So if it's a mortgage, or an auto loan, it's assumed you're paying off a loan. You're paying off a credit balance. So it's no surprise that after you make each payment, there's still, a balance left on the loan. There's no big deal with that. On the other hand, credit cards, so it really depends. you in general don't want to borrow a high percentage of a credit card's limit. So let's say that you have a $10,000 limit on a Visa card. Okay, if you're carrying a balance consistently of about $9,000, okay, and you're carrying that month after month after month, that's not a great thing. Okay. On the other hand, if you're carrying a balance of $500-600 on a $10,000 credit limit, not any particularly big deal in general. Okay. So payment history is the first thing that the first type of information, or one type of, I shouldn't say the first, it's one type of information that's used in determining your credit score. Another is credit utilization. Okay, so that gets back to what I was just saying a minute ago. Let's say you have a credit card with, and let's say you just have one credit card, okay, and it has a $10,000 limit, and you have a $9,000 balance. So your utilization in that case is 90%. Okay, now that high a credit utilization rate, it would tend to lower your credit score. On the other hand, if you're using $1,000 of a $10,000 limit, so that's a 10% credit utilization rate, and that's not going to have any kind of negative impact on your credit score. Okay, now many of us have more than one credit card. So we may have the ability across all our credit cards to borrow, say, $70,000 or something like that. So, but even when you've got multiple, so when you have multiple cards, okay, one of the things you want to be careful is make sure that overall, the amount that you're carrying in balances on the cards is about 30% or less than the total of the credit limits. So let's just take a situation where you have 4 credit cards with total credit limits of $70,000. So if you're carrying total balances of about $20,000, that's less than 30%. 30% of $70,000 is $21,000. So you're below the 30%, you're probably okay. All right. Now, keep in mind, though, that if, let's say, you've got one credit card with a $20,000 limit on it, and the entire $20,000 is on that one card. So that high usage of that one card could affect your credit rating negatively, even though your overall credit utilization is below the 30% level that's generally considered to be okay. All right, next is the length of your credit history. So, and this is what I was talking about at the beginning. You want to establish credit as soon as you can, especially if you have a goal of, maybe you have a goal of buying a house when you're in your, mid to late 20s. So you want to establish credit as soon as possible, because the length of your credit history will have an impact on your credit score. So if you have a 1-year credit history, that's not nearly as good as if you have, a 10-year credit history, or, an old guy like me, I've got, a 40+ year credit history, actually, not 50, not quite 50 yet, but a 40 year plus credit history. Okay. So, you do want to establish a credit history as early as possible, keeping in mind that you want it to be something that you can properly manage given where your finances are at right now. Okay. And so that, you not only have a long credit history, but you have a good credit history in the sense of you're making your payments on time. Now, to go back to payment history for just a minute, generally paying on time means paying by the due date. However, if you are a few days late in making a credit card payment, generally speaking, that will not get reported to the credit bureaus. And in fact, in general, creditors tend not to report a late payment until it's 30 days late. Okay, now that's in general. Now, this is not, permission to pay your credit cards late. It's only that, if you're in a tight bind, and people are these days, and economic times have been tougher the last couple of years. So, if you have to pay a credit card a couple of days late because you're not getting your paycheck in until Friday, and the bill is due on Thursday, well, you're better off waiting a day till the money is in your account and then making that payment than trying to monkey around with paying it in advance and hoping it'll clear. And then if it doesn't clear, so if you have a bounced payment, that will affect your credit history, no matter what. Okay, so it's something to think about as you manage your finances, especially if you're kind of strapped. You do have a little bit of leeway there in most cases. Okay, credit mix. So credit mix means you have different types of credit accounts. So there's what are called credit cards. So a Visa or a MasterCard. Those are cards where all you have to do is make a minimum monthly payment. And if you want to carry a balance, that's really up to you. Okay. Then there's something called a charge card. So American Express is the most well-known charge card. And I mean, there used to be others. There was Diners Club, and some others. I don't even know if they're around anymore, frankly. So with American Express, it's generally speaking, you're going to pay off the balance at the end of each month. Well, I shouldn't say at the end of each credit period, because it's rarely does it coincide with the end of the month. Now, American Express does have a feature called pay over time. So if something you charge is of a certain size, I think it's over $200 if I remember correctly, or $300, something like that. So then you can carry a balance for those larger charges if you want to. But generally speaking, with an American Express card, you are going to pay off the balance at the end of the credit period. Okay, so that's what a charge card is. This is probably not the case anymore, but in the early days of department store credit cards, do you all know what department stores are anymore? I mean, they were, when I was younger, that's where you went to shop for clothing. Places like Robinson's, May Company, Macy's, Bloomingdale's, Barney's, Saks Fifth Avenue. Barney's and Saks Fifth Avenue, those were high-end department stores. Macy's and Bloomingdale's were kind of mid-range, and same with Nordstrom's. And then there were places, JCPenney, Sears. So these were department stores, and they issued what were called charge cards. And in the beginning, you paid them off at the end of the month. So you could go in the store and you could buy whatever you want. You use your charge card. And then at the end of the month, they'd send you a bill, and it was expected you would pay off the entire bill. So, I mean, nowadays, first of all, there's very few department stores left. And second of all, they tend to have a lot of them, there's only a few, but I think they tend to cooperate with like Visa or MasterCard in terms of their credit, offering credit to their customers. But in any event, you have credit cards, you have charge cards, and then you have what might be kind of grouped together as term loans. Okay, so an automobile loan, right? Generally speaking, an automobile loan is for a specific length of time. Could be 3 years, could be 4, 5, 6. There are even 7-year car loans now available, especially for very expensive higher end cars, in order to bring the payment down. Okay, so that's a term loan. You're borrowing the money for a specific period of time. You're making monthly payments until it's paid off. Now, by the way, a car lease is, while you're not buying the car, you are still financing the car, and that is a type of credit. Okay, and leasing agencies, will report that information to the credit bureaus, which we'll talk about what those are in a minute. Okay, so just because you're leasing a car doesn't mean somehow you're, the keeping up with the payments is not as serious, if you will. It definitely is. Okay, so that's another form of credit is like a car lease. Okay, but a car loan to buy the car is a term loan. So is a home mortgage, okay, or a home loan. So generally speaking, you're borrowing that money for 30 years or maybe 15 years. There are 40-year home loans, I think now. But the typical home loan is 15 or 30 years. And again, it's got monthly payments and at the end of the term, the loan has been paid off. Now, it is the case that very few people actually pay off their home loans. Although nowadays, because of how interest rates have gone up so much, mortgage interest rates have gone up so much, people are staying in their homes longer than they used to. It used to be people moved roughly every 7 years. Whoa. But now I think because people have these very low rates, they're reluctant to sell their home and move somewhere else because they can't afford a new home with the higher interest rates. So we may return to a time when people, bought a home and lived there and paid off the mortgage. Okay, so credit mix can also impact your credit score. Okay, and that's not to say if you don't have a credit mix, you're going to have a bad credit score. It's just those with a credit mix who also have positive length of credit history, credit utilization, payment history. They're probably just going to have a higher credit score than people without a credit mix. Okay, and then finally, new credit inquiries will also affect your credit score. So when you apply for credit, okay, the company that you're applying to is going to check your credit. They're going to pull your FICO score. They're going to pull your credit reports, and that they did that ends up on your credit reports. Okay. And to have a new inquiry once in a while, not a big deal. But if you have a whole bunch of inquiries over a short time, that can impact your credit score. So one of the places where I've seen this happen, because I used to have a real estate company, is where people are where someone is looking to rent an apartment, okay, and they apply to multiple apartments, to see if they can, get approved to live there. And so they'll have, 3, 4, 5 credit checks in a very short period of time. So that can negatively impact their credit score. So I did deal with tenants from time to time who, brought a copy of their credit report with them when they came to see an apartment, and they would ask, can I just give you a copy of my credit report so I don't get another inquiry on my record, because I am looking at several. And my response would be, that's fine for now. However, if you decide that you do want to live in this building, I am going to have to run a fresh credit check, in order to make the final decision. So I can't make a final decision off of a credit report that you hand me. That was the policy of my company. And the reality is, did I think these people were being dishonest? No, I didn't. I had no reason to think they were, but standard of practice is, for that one time in 100 or 1,000 where someone would, have a fake credit report. I couldn't take that chance on my client's behalf. That wouldn't have been prudent. And so, I had to insist on, doing my own credit check. So credit inquiries, again, can have an impact on your credit history and therefore on your credit score. Okay, let's next one. All right. So I mentioned earlier FICO scores. Okay, Fair Isaac Company. They are the best known. I'm going to go to their website. I don't know what's going on here. Okay, I'm going to go to their website so we can see some information there. And yes, here we go. Okay, so this is, FICO's website, what they call it, My FICO. Okay, you can see it's the most widely used credit score. Credit scores were created by Fair Isaac Corporation. I mentioned that, and 90% of top lenders use FICO scores. So this is some marketing stuff on their part, but they want you to believe that they're the best, they're the biggest, all that kind of stuff. I mean, they're certainly the most well known. I'll give them that. Okay, so what I want to focus on here is this part. What is a good credit score? So I mentioned earlier that the range of FICO scores, and I'm going to call them FICO scores now because other credit scoring companies don't necessarily use the 300 to 850 scale. So a FICO score ranges from 300 to 850. Okay, and the higher the number, the better the credit risk. Okay, so FICO considers a good credit score, and they put that in quotes, to be 670 to 739. Okay, that's good. So, and you see here in this chart how they rate various credit scores. Okay, so anything below 580 is considered poor. Now, that doesn't mean that you can't get credit, and we're going to talk about that in a few minutes. It just means that you don't have a lot of credit worthiness, and so your ability to get credit is going to be different than someone, and the terms of the credit are going to be different than someone who has a higher credit score. Okay, so a fair credit score is 580 to 669. Okay, so there's a 119 point range there, and that's fair. Okay, and again, just because you have a fair credit score doesn't mean you can't get a loan. You certainly can. Okay, and we already talked about a good credit score, so 670 to 739. You can see, by the way, that the gaps are getting smaller. So this is a 69 point gap. This was 119. This was 6. This goes down to 69. Okay, so a good credit score is one that's near or slightly above the average of U.S. consumers. And again, most lenders consider this to be a good score. Okay, very good is 749 to 799. Again, the gap is 50 or 49 actually. No, I'm sorry, 59. The gap is 59, and this is an above average of U.S. consumers. And then finally, anything over 800, so 800 to 850, which is a 50-point range, is an exceptionally good credit score. It means that you're an exceptionally low risk. Okay, so how does this work in practice? So let's say that you want to get a car loan. So in general, if you have a FICO score in the very good to exceptional range, okay, so that may be all the car lender looks at in order to approve you. Okay, that's why it's so valuable to have a good credit score. So I remember this is going back a number of years now, but FICO scores did exist, and I was looking to buy a new car. I think this is when I bought my Jeep, my first Jeep, because I have another one now. And I called up the credit union that I was at. It was a USC credit union, and I said, I'd like to see if I can get a car loan. And they said, okay, well, do you have a few minutes? I'm like, yeah. They said, okay, we can do it over the phone. I'm like, really? And I mean, now you could do it on the internet. And so, the person asked for just some basic information, my name, my address, and I think my social security number and my birth date, as I recall. And like 5 minutes later, came back on the phone and she said, okay, well, how much do you want to borrow? I said, what do you mean? And she said, well, how much do you want to borrow? I said, well, I'm getting a Jeep. I think it's, I think it's going to be around, I think at the time, $25,000, whatever it was. And she's like, yeah, okay, no problem. So I said to her, I said, you mean if I want to buy a Rolls Royce, you're going to lend me money for a Rolls Royce? She's like, yeah, given your credit score. I'm like, do you know that I can't afford a Rolls Royce? She said, well, presumably you know that, and you wouldn't buy a Rolls Royce, and that's why you have such a great credit score, right? I mean, it really kind of blew my mind. This was the first, contact, if you will, that I had with credit scores. But I mean, it made, getting a car loan so much easier. Really kind of, like I said, it really kind of blew my mind. So, that's why, again, I stress this, you want to be in the very good to exceptional range, okay? And so, you really want to be targeting a FICO score of like, 750 and above, let's say, probably puts you in pretty good, pretty good shape. Okay, so let's go back to our PowerPoint now, and continue with some other issues. That's weird. Okay, so, all right. Let's talk now for a few minutes about credit bureaus, okay? Because this is basically where FICO and other credit scoring companies get their information. So there's three main credit bureaus in the United States: Equifax, Experian, and TransUnion. And they all do basically the same thing, although there are differences in how they do what they do. And so if you ever were to pull, say, your Equifax and your Experian credit reports, you would see that, sometimes you'll see something reported on one that's not reported on the other. Okay, so that just has to do with the periodicity, how often they update your file, and other policies that they have. So essentially what happens is creditors periodically report data on everyone who's borrowed money from them to these three credit bureaus, and they compile all that information into what amounts to a credit profile for each person. Okay, so let's say you've got a Citibank Visa. Okay, well, I mean, I don't know how many people have Citibank Visa cards, but it's millions upon millions. So it's not that Citibank reports your data individually. What Citibank does is, I believe monthly, they transmit all the payment data on all of their card holders to Equifax, Experian, TransUnion. And then these companies take that and basically separate it all into individual credit profiles. Okay, so that's really what their function is to take all this sort of, what's the word I'm looking for? These large data groups, and sifting it so that it's usable for creditors when they want to make decisions about whether to issue credit or not. Okay, now all three credit bureaus are required to give you a copy of your credit report for free so that you can check them periodically. I think they have to do it once a month. Okay, they can't charge you for it, nor can they ding you on a credit inquiry for sending you a free copy of your credit report so that you can see what's on it and make sure that it's correct. Okay, so you're going to see in a few minutes, one of the things I'm going to recommend is you do periodically check your credit reports. We all need to do that, me included. to make sure that they're accurate, and there are laws that govern what the credit bureaus have to do, so that by keeping up with our credit profiles, we're not also damaging our credit scores. Okay. All right. So that's enough for credit bureaus. I want to move on because I don't want to run out of time. Okay. So what the credit bureaus compile is your credit history or your credit profile. Okay. And if you pull one of your credit reports, first of all, it's going to have personal data. Okay. So your name, and if you've lived under more than one name, you will oftentimes see more than one name on your credit report. So if you're a woman who got married and you took your husband's last name, so you may see that both your maiden name and your married name are on your credit report. Okay, it's going to have your date of birth. It's going to have your social security number. It's going to have addresses. Okay, addresses, I think, go back, I want to say, for 10 years. I could be mistaken about that. But they're going to be addresses at which you received mail in particular. Well, these days, credit card companies don't, they don't send bills usually. All that stuff happens online, but you're still going to have to have a physical address. Any credit card company or any company that extends credit is required to have a physical address for you. And so any of those addresses that you've given to any of your creditors, that's all going to be compiled in your personal data. Okay, next is consumer debts. Now, I want to be clear. Consumer debts are debts that you owe personally. Okay, so let's say that you own a business and that business is a separate entity. So it's not what's called a sole proprietorship. A business that's a sole proprietorship, it's really just you. Okay, but if you have a business that's an LLC or that is a corporation, okay, that business is a separate entity. And if you have a credit card, if your business takes out a credit card, that's not going to be reported on your consumer debts because it's not a consumer debt, it's a business debt. Okay, so your business is going to have its own credit history, its own credit profile. Okay, so these are consumer debts. So it's going to include all the ones I mentioned before: credit cards, charge cards, auto loans, home loans. Okay, and it's not just going to have ones that are open. It's going to have ones that are paid off or ones that are closed. Okay, so if you have a credit card that you haven't used for a period of time, in fact, this just happened to me. I had a credit card where the credit card company, they closed it. I think I had forgotten that I had it, frankly. They closed the account because it hadn't been used for years. Okay, so that closed account is going to show up on my credit history. Okay, and it's just going to show as closed. It's going to show closed for non-use. Okay, there's nothing bad about that per se. However, and here's the however. Remember, we were talking about credit usage. So if that account was open, and let's say it was, let's go back to that example of $70,000 in total credit available. Okay, and let's say that account that was closed by the creditor because for non-use was $10,000 of that 70. And let's further say that you have $20,000 in outstanding balances. When that card is closed, bang, now you've gone from $70,000 of available credit to 60. It's lowered. And now the 20,000 represents a third or 33% of your balance, not less than 30% of your balance. Okay, so can you see how having an account closed automatically for non-use could still potentially affect your credit score by raising your credit usage percentage? Okay, so that's why you want to kind of keep an eye on all this stuff, and just be aware of how it might affect your credit score. Okay, so all your consumer debts, both open and closed. Payment history. So that's just what we talked about before. That's your history of payments. And generally, you're gonna have paid as agreed, which means paid on time, 30-day lates, 60-day lates, 90-day lates, charge-offs. Okay. And then, by the way, bankruptcies will also show on your credit report, at least for a period of time. Okay. So if you had debts that were wiped out by bankruptcy, those debts are going to show as being wiped out by bankruptcy. They're not just going to show zero. Okay. And that obviously that will, at least for a time, negatively impact your credit history. Now, bankruptcies stay on your credit history for 10 years. And after that, they're supposed to fall off automatically, although not always. Mistakes get made. Okay. But they don't necessarily negatively impact your credit for 10 years. Most people, even after 2 or 3 years, can reestablish credit. And as long as their credit is good from that point going forward, over time, the bankruptcy, even while it's still on the record, will have less and less of a negative impact on their credit score. Okay. Credit application activity. So those are inquiries. Okay. And again, those will show up. And if you get a whole bunch of them over a short period of time, that can negatively impact your credit score. So you just want to be aware of that and be careful of that. By the way, opening up a whole bunch of new accounts, over a short period of time, even though you've been approved, so wow, I have great credit, I got approved for all this new credit, still opening up a whole bunch of new credit over a short period of time, that can also negatively impact your credit history. Okay, so before we get off of credit history, I want to deal with two specific cases. One is Sallie Mae and the other is the IRS. Okay, so Sallie Mae is the federal school loan program. Okay, so if you have school loans, Sallie Mae does submit payment history on your school loans. Okay, now there are forbearance programs. There's all kinds of stuff that you can do with Sallie Mae, and there are all kinds of payment programs where even if you're struggling to make your payments, you can you're not actually going to deal directly with Sallie Mae. You're going to deal through your loan servicer. Okay, and they have programs to help you keep current with your student loan payments so that they don't have to report negative information. So I believe payments started up this month, October 1st, I think it was. So people haven't had to make school loan payments for about 2 or 3 years, whatever it's been. Okay, and I can imagine that in the meantime, people have taken on other periodic payments, monthly payments, and they may be hard pressed to make their school loan payments. Don't just let it sit and do nothing. Contact your servicer and see what programs may be available to you to keep them current, because it does go on your credit history. Now, the IRS is different. So in general, the IRS does not report tax payment information to the credit bureaus. So if you are late paying your income taxes, they're not going to report you to the credit bureaus. However, at the point where you have a tax lien placed on you, so that lien will be in the public records, and at that point, that information can be picked up by the credit bureaus. So it's not really that the IRS is reporting you per se. It's just that now that your tax problems, if you will, are a matter of public record because the tax lien is filed. So the credit bureaus do collect publicly available information. Okay, so let me just distinguish for a minute so you understand the difference. when, let's say we were using the example of Citibank, when they report the payment information on their cardholders to the credit bureaus, that is not public information. That's private information, and it is not permitted for them to publicly disclose that, okay? They have to keep that information private. Now, the exception is they can report it to the credit bureaus, but the credit bureaus too have to keep that information private to a certain extent, and only under certain circumstances can people get access to that information. So I can't just go online and get, the credit information from, somebody living, John Smith living in Virginia. Okay, that is it. I can't do that. Okay, but issuers of credit, they are able to get access to other people's credit information because they have the authorization of those people to get access to that information, so the potential creditor can make a decision as to whether to give them credit or not. Okay, so all of that information is private, but there are pieces of information that are public, and any kind of lien that's filed, that becomes public information. Okay, so for example, let's say that you get sued and unfortunately you lose. Okay, so as part of the process of collecting that court judgment, the person to whom you owe the money, they can file a lien against all of the real estate that you have in a particular county. Okay, that lien now is a matter of public record, and it can be picked up by the credit bureaus in the same way that an IRS filed tax lien can be picked up. Okay, so again, it's not the individual or the IRS reporting it to the credit bureaus. It's the credit bureaus picking it up out of the public record. Okay, and indeed, anyone can find information that's in the public record. That's why it's called the public record, right? So just be aware that there is a difference between the two. Okay, so that's credit history. I think we got one more. Okay, lender use. I think this is the last one. Okay, so how do lenders then use the information they get? Use the credit score. So the credit bureaus compile all this information, and FICO or the other credit scoring companies, they pick it all up and they give you your credit score. Okay, so the bottom line is they're going to look at that credit score to assess credit risk. Okay, how likely are, as the again, I'll use Citibank. We've been using that as, Citibank credit card company, whatever they call it. How risky is it for me to give a credit card to, with let's say a $10,000 limit to this individual? Okay, that's what they're looking at. Okay, so based on your credit score, the creditor, or the potential creditor, we'll call it, will approve or not a loan or a credit card or a charge card or whatever. Okay, now there are some numbers at which, for the most part, they're just going to say no. So if you've got a 400 credit score, it's probably going to be pretty tough to get approved for any kind of credit. Okay, having said that, if we're looking at mortgages, so in general, if you've got a 620 on a mortgage, a 620 credit score, FICO score, okay, you will be able to get a mortgage. Now, we'll talk about interest rates and terms in a minute. Okay, but look with FHA. Okay, you with 580, you can get a home loan with a 3.5% down payment. And with a 500 credit score, FHA loan, you can get a loan with a 10% down payment. Okay, now those are pretty low. Remember that a good credit score is around 610 or so to 739, I believe it was. So the FHA scores are in the fair range. Okay, and nonetheless, you're able to you're able, potentially able to, qualify for a loan. In fact, the 500 is below the fair range. That's in the poor range. Okay. Now, by the way, in getting a home loan, credit score isn't the only thing they're going to look at. They're going to look at income, et cetera. So, but you can see that these are pretty, pretty low, relatively speaking. Okay. Now, with an auto loan, you can get an auto loan with a credit score even at 500, not unlike, an FHA. And in fact, you can get them for even lower than that. But you're probably going to be facing some pretty onerous terms. Okay. So in general, to get a car loan, a used car loan, you need to have a credit score of at least 675 and a new car loan of 730. However, again, you may be able to get a new car loan with a credit score as low as 600. Okay. So just because, just because you don't have a 730 credit score, don't, throw up your hand and say, oh, I'm not going to be able to get a car loan. Okay. Do some investigating. Okay. Now, the reality is in many cases, the lender is not going to say no. What they're going to say is, well, based on your credit score, we'll offer you a loan on with the following interest rate and terms. And the fact of the matter is, if you've got a very good to excellent credit score, so you're going to get the best interest rate and terms that the lender has to offer. Okay. Once you start getting below that, though, then what's going to happen is the lender is going to look for a higher interest rate and better terms. So better terms may mean more cash up front or some cash up front. There are lots of 100% auto loan programs, for example. But if you have a credit score below whatever that lender has as their cutoff, they may not say no, but they may say, well, look, if you can put 20% down, then we will give you a loan with the following interest rate for, maybe 3 years. Okay. And the other thing they'll do is, if you've got a kind of, sub good credit score, so they may offer you credit, but for a shorter period of time, because that, at least in theory, reduces the risk that you won't pay it off because it's not extended for as long a period. Okay. And so you say, well, wait a minute. If you know anything about loans, the shorter the term of the loan, the higher the payment. And that is, generally speaking, that is true. And what they're going to do to offset that is require a larger down payment in order to keep the loan payment affordable to you. Okay. So that's in practice how lenders use credit scores. Now, again, keep in mind, while for an auto loan, if you have an excellent credit score, that may be all they check. If you don't have that, they may require additional information on, for example, what your income is and et cetera, et cetera. They may, require you to submit an income tax return so they can verify your income. Especially with a mortgage loan, you're more likely to have to submit proof of income, whether it's bank statements or whether it's tax returns, whatever it is. And that can vary a lot. I don't want to get into that today, especially because we're almost out of time here. Okay, but again, this is generally how credit scores are used. Okay, last thing, and this is how to improve your credit score. And from everything we've talked about, these should be pretty obvious. So pay bills on time and in full each month, right? Just make your payments, okay? Keep your credit use low. That's your utilization rate, under 30%, okay? I mentioned this before, avoid opening many new credit accounts in a short time, okay? For the reasons I spoke about before. And then finally, regularly check your credit reports for errors. Do you have to do it every month? Maybe not, maybe once a quarter would be fine, but you do, especially if you're planning on looking for a major loan. Maybe you're going to get a car loan, or you're looking to buy a house maybe in the next 6 months or a year. So at least 6 to 12 months out, I would encourage you to get a copy of your credit reports and make sure they're accurate. And if not, then you have time to get any inaccuracies corrected so they don't negatively impact your credit score, and therefore your ability to get the loan that you're after. Okay, and I do think that's the last one. Yep. So as always, here's places to get information, ask questions. Again, if you want a copy of these slides, you can send me an email to thewaytowowshow@bemel.com. Happy to send them to you. And then I think we have, yes, the legal stuff. So I'll go ahead and stop sharing. And that is credit scores. Not too painful, was it? Hopefully a lot of good information so that you understand them better. And that's really the key, is just understand what it's all about so that you can deal with them effectively and you can make your credit score work for you instead of working against you. So that's the show for today. Thank you for being with me. I appreciate it. And in fact, this is the last show for the week. Next week on Monday at 10 a.m. Pacific is Trust and Estates Weekly. I'm having a guest, Vaughn Marie Thomas. She's an accountant who specializes in trusts and estates based in New York City. So I invite you to join me, to join Vaughn Marie and me. She is very, very knowledgeable and a really terrific communicator. So please, if you possibly can, join us for that show. On Tuesday, Business Lessons from the Military at 11 a.m. Pacific. We're going to continue our discussion of the use of intelligence in the business world. That's spy versus spy intelligence, as I've been joking for the last week or so. And we started that yesterday, and we're going to continue with it next week. And then 7 days from today will be the next edition, the next episode of People Making Money. And to be honest with you, I don't remember what it's about, but do tune in, and we will have another discussion as we look to improve our professional success and build wealth together. So thanks again for tuning in. I appreciate it very much. Wishing you a wonderful rest of the week, and signing off. Marie, you are my bell. All the best, folks.